What's going on, guys? Welcome back to my channel. This is Blood Fancy Media One. So I know you guys got used to me uploading maybe once a week at most, but most likely like twice a month or once a month. But now you're gonna get videos a little bit more often. Hate to break it to you guys, that's what you get for not wearing your masks, but you're gonna see more of this face and hear more of my voice. All right, so yeah, let's jump right into it. So I've been hearing a lot of comparisons between today and 2000. And by 2000, I mean the dot-com bubble, where between the years of 1997 to 2000, the market did remarkable things. Nasdaq was exploding. Basically, tech just became this huge bubble, but it lasted for years, like 2, 3 years, basically. And even between 1987 to 2000, there's still a lot of growth in the stock market where you did have some really sharp corrections, similar to the one that we just had back in March, but you also had some very sharp recoveries, which is exactly what we had back in April. So beyond that, obviously, the way that we view tech, I think, is starting to become similar to 2000 as well. So a lot of these comparisons are pretty valid. The first thing I want to do, actually, before I jump into the data points, is just summarize what's been going on this week. I don't think it's worth it to go over my account because the market just has gone sideways. The only updates I have is that I paid my taxes, so I withdrew like 13 and a half grand to pay taxes, but it is what it is. Yeah, let's just jump right into the charts. All right, so this is the S&P 500, and regardless of how you look at it, this is a 1 hour chart, so each of these candlesticks represents 1 hour's worth of time. I'm basically looking at the entirety of 2020, and no matter how you look at it, this has like a very, very strong look. This has a bullish look. I'm pretty sure the market's going to break out to the upside. At least that's where my bias is. Obviously, we do have this area of resistance, which we can go ahead and draw out. But the way that it's been behaving at this resistance is that, when we butt up our heads against it, the pullbacks are getting more and more shallow. So once we hit it at this point, which was back in, I was going to say July and June. Back in June 9th, there was obviously a pretty sharp pullback. It took maybe another month before we could retest it again. We got a pullback, and then we retested it again, and we got an even smaller pullback. And then part of the reason for the resistance here, I think, is because of the gap area that needs to be filled here on SPY, which was opened back on February 23rd of earlier this year. And so, yeah, we've just been butting up our heads against it. But, this is an hourly time frame. So, like I said, every candle represents an hour. But regardless of how you look at it, this very idea of basically buying support getting stronger every time it gets rejected, this idea of supply and demand can be used across all different time frames, whether we're looking at a weekly time frame or a hourly time frame or a minute time frame. So that's why I say, regardless of how you look at it, this looks bullish. And so my bias is to the upside. And once we do break above here, because it's been acting as resistance for so long, I anticipate the reaction to be quite strong. But it's possible that after we fill this gap area, like I said back in late February is when we opened it, it's possible that we fill it and then we get rejected a little bit because it takes a lot of energy to sort of to fill gaps, basically. And I hate using words like energy, momentum, blah blah blah, because it just sounds so like esoteric. But that's basically how I think about it. So I would expect us to fill that gap area. Maybe we pull back a little bit. Maybe we make a sharp bounce after that before we see something steeper. And so this is the Nasdaq on an hourly time frame as well. As you guys can see, these support areas, these moving averages, which are the 200 and 100 period moving averages on the 1 hour time frame for the QQQ, they've been holding extremely steady. And basically, most of the time, the 100, which is this orange line, will act as support. But if that doesn't hold, then the 200 certainly will. And that has so far been the trend. And the exact area that we bounced off of was right here, which is the 100 period moving average. So until we break this, it seems like the pressure is still to the upside. And since these moving averages have held a support for so long, I think breaking them might be tough. But with that being said, once they do break, I think the reaction will also be pretty strong. And so I'm still holding longs here as long as we can hold above these moving averages. I'd happily sell if I can sort of time some kind of reaction. I do have some, I guess, insurance is what I would call it. Basically, some put options which are dated about a month and a half out from here, just in case something does break. But yeah, for the most part, just shorting a tiny bit, just staying cautious, but still somewhat in the trend. What we're looking at next here is a weekly time frame of the Nasdaq Composite Index. So it's basically not as heavy weighted into certain stocks as the QQQ, which is a Nasdaq ETF, but the similar idea basically. So they're actually very similar. And so what I really want to point out here is MACD, which is a sort of like a momentum-based indicator. And as you guys can see, MACD is actually more overbought than it was before the February and March crash. And if we actually zoom out and we take a look at what it was in the dot-com bubble, we'll actually see that the two time periods are actually pretty similar. As you guys can see, it might be hard to see it, but yeah, basically just look at this horizontal line that I have here, this horizontal dashed line. We're actually, in terms of just sheer momentum, we're actually pretty similar as this time period right here. So there's going to be more stats that I'll be sharing out through this video. I just want to take the time to say here that once the S&P sort of fills out what I think it will, which is some kind of follow-through move, because the S&P, utilities, and financials and industrials look like they want to move higher. Tech obviously looks a little bit weaker, but once that move sort of follows through and the S&P 500 gets close to all-time highs, I will be a lot more cautious, especially now with how strong momentum is on the Nasdaq. I just, it's either one of two scenarios. Either we have some ridiculous rally like we did in 2000, or we have an expected pullback. And so obviously the market can do the thing that's way, way, way more rare. Often we don't see rallies such as we have in 2000, which I'll go ahead and share after I give this little rant. But personally, I'm going to go with the option that's the most common, I would say, which is, take profits quite soon. That being said, I'm still, I'm buying Visa, I'm buying MasterCard, I'm buying XLF, which is the financial sector. I'm buying XLU, which is the utility sector. I'm actually up quite a good amount on most of those positions, maybe anywhere from like 4 to 10%, usually on options, actually. Longer term dated options, I should say. So yeah, like I don't want to give a conflicting message like, oh, I'm telling everybody to run away and start selling their stocks when I'm actually still buying a little bit, but it's way more selective. I'm not buying tech that often, for example. And so what I want to share here is this is the Nasdaq, and so basically between honestly the early 90s and all the way to 2000, the middle of 2000, it was just like an awesome run, and it looks like there's more of a run here than here, but that's only because of the way that this chart is scaled. If it was a log chart, for example, then it would look a little bit more balanced. But yeah, what I want to highlight here is back here in 1998, we actually had a retest of the 200-week moving average, which is exactly what we had back in March of 2020. But after that, we had a ridiculous run where the Nasdaq pulled off 267% between September 1998 and February 2000. So that kind of thing is pretty unprecedented. I think we will probably see some similar blow off top if I had to take a guess. I don't know if it's going to be now or if we're going to have a pullback. But yeah, I guess the ideas that I have for why I'm bullish long term can probably fit in another video. But I just want to share some examples of the Nasdaq really, doing things that people wouldn't expect. And this is between 1995 and 1999. So obviously, like, there's some really strong rallies, but there's also some really strong pullbacks. Like, for example, between 1996 to 1996, between May to July, there was a 17% drop. And then between February 1997 and April 1997, there was again another 16% drop where we just, retested the 100-week moving average. Between October 1997 and January 1998, we had another 15% drop. And then back here in July 1998 and October 1998, we actually had a 31% drop from peak to trough. And I can actually like go back in time and basically share the exact same thing. I mean, if you guys are familiar with what Black Monday is, you know that was, you know, a pretty scary time for the market. Actually, this is what is this? This is July 1990 all the way back to October 1990 as well, where you had a 29% drop. And then just for completeness, we'll just show Black Monday. If you guys have seen Wolf of Wall Street, this is actually one of the first scenes in the movie, where, yeah, so here in Black Monday, the market dropped. I guess like on the Monday, I don't know how much it dropped necessarily. I guess it was this day, so maybe like, I don't know, 18% or something. But from peak to low of this period, it was like a 35% drop. And so that's basically the point I want to make is, when the market is sort of setting up for really powerful moves, I think it's common. I think it's okay to see really nasty drops like the one we've seen in March. But it's also good to be prepared. Like, you know, those drops may come obviously, but try not to get left out either. And in my opinion, my bullish thesis, my bullish idea is that the market is going to be pretty prosperous for the next, I don't know how long, but that's probably, I could say that for another video. Okay, so on one of my last videos, I showed the put-call ratio. I think a moving average of the put-call ratio. This right here is the daily sentiment index, so DSI. You guys can do more research on what this actually measures. I won't be doing that in this video, but basically this is a moving average, 50-day moving average of DSI. And so the reason why you have moving averages is basically like to basically get like a compound sense of different data points all at once and basically smooth out the trend. So basically, when the moving average hits certain points, we can obviously have pretty nasty reactions. And daily sentiment is basically obviously calculated every day. But the idea is that this is overbought and then this is oversold. So you want to be cautious when sentiment is too bullish. And so these are periods when sentiment is too bullish. And so we are getting up to that point. And like, you know, don't take it as like an exact measurement because it is a moving average. So, you know, obviously with here, it doesn't mean that we have to turn back down. This is just a rough idea of where sentiment is at various points in time. Speaking of sentiment, so this is a measure of demand for at the money calls for Amazon in particular. And we currently have an all-time high for demand. The ratio is basically this caption right here, so you guys can go ahead and read that. I'm just going over it very quickly. So yeah, obviously there's an all-time high for demand of calls using this ratio. So we are going to take a look at Amazon right now. As you guys can see, I have it on the screen. But I sort of just want to point out, like, everything I'm saying, especially with blow-off tops, a lot of times they continue running up once we have a traditional sense of what overbought means. Overbought, and especially in the context of trying to time tops, is very, very difficult. Timing tops, in my opinion, my experience has been way harder than trying to time bottoms. So even in situations where the market should or shouldn't, you know, keep rallying, it can still surprise people. However, that doesn't mean that you give up on that idea. And actually, this is kind of like a learning experience for those of you who have been subscribed to my channel. I actually tried shorting the market back in January of 2020, and I was like excited about my positions. I shared some ideas about that, and it wasn't until February where the market just kept on rallying, and I basically at one point I said I'm taking off my shorts, and then like a week and a half later the market dropped. Like literally the the February drop happened once I had taken off my shorts, once I like let my guard down. And so, yeah, I mean, at this point, I'm willing to be a little bit more patient with what I consider to be overbought. And when I see it playing out, I'm willing to, you know, it's okay to be wrong for a few weeks. Obviously, if I'm wrong for too long, then I have to reevaluate. But I'm not gonna let that happen again for now, at least. All right, and so this is Amazon. I think I've looked at Amazon before in the past on this channel. It sort of looked like we were gonna have our breakout here back in February of 2020, but then obviously that didn't happen. But basically, yeah, there was a time period where Amazon didn't really do anything, and it can be described by this triangle as well as this 100-week moving average. The awesome thing about tech is just how much it respects like really simple moving averages. I would say all of the FANG stocks are all pretty nice. Like they play nice with moving averages, so that's always good. But yeah, we didn't really go anywhere, and generally consolidation patterns lead to really strong breakouts depending on where that breakout is. Not, obviously not all the time you'll have bullish breakouts, but with something like Amazon, Netflix, Google, Facebook, it's almost like a given that if they consolidate for a while, then they're going to break out. So not only did we not break out here in February of 2020, but we almost had a bearish breakdown. And so this looked bad for a while, but this is obviously what I would call a bear trap. And so we just went right back up. I don't know if, a lot of people started shorting Amazon at this point. But a bear trap is basically a point where bears sort of start to gain hope and pile in a lot of shorts. And when sentiment gets too bearish, then that obviously leads to really strong reactions in the opposite direction. And so that's exactly what we got with Amazon. It took like a year and a half for this to actually unfold. But we finally did. And Amazon hit its peak here at around $3,300. It looks like we're starting to break down a little bit. And what I'm looking at here is Amazon for the first time actually having 4 out of 5 red days. So that's 1, 2, 3. Yeah, so 4 out of 5. I don't consider this to be the same thing because as you guys can see, some of these are actually gap up opens. And so they're not necessarily red if you open up higher than the previous day, or I should say if you close higher than the previous day, that's still a green day, even if the candle is red. But yeah, so could be a sign of momentum sort of getting weak. Maybe it's just resetting a little bit before continuing higher. I'm not sure, but I'm playing it a little bit more cautious here. And this is Netflix. It almost looks like I didn't even change the chart. Let's actually go ahead and do that again. So look, that's Netflix, and then that's Amazon. But I guess people want to act like stocks aren't correlated, right? Let's go ahead and throw back Netflix. So whatever I just said about Amazon, I can pretty much say about Netflix as well. Let's zoom out just a little bit. Oh, and what do you know? So Netflix has also been in basically a consolidation range for about a couple years. The idea is, basically the same thing. Doesn't matter what shape it is. It's just the idea that between 2016 and 2017, all the way up to 2018, tech absolutely crushed it. And by tech, I mean FANG stocks. And then they consolidated for a while, and then Netflix actually broke out. These are two completely different businesses, basically having the same pattern, and that's how stocks move, basically. And similar to Amazon, there is a pretty, I would say, like ominous looking candlestick here. I usually don't put that much weight into single candlesticks, obviously, but there isn't like a name for this. I don't like to name candlesticks. Again, it just makes technical analysis seem so like esoteric. But the idea here is that this is almost like a bearish engulfing candlestick where you engulf the previous day's candle. So we don't necessarily have that, but the idea is that, like, if let's say we didn't close this low, let's say we close like up here, then this would have, like, I think the official term is like a hanging man or something, like a hanging man candle. But this is actually worse than if we were to have closed up here. And so, like I'm saying with the Nasdaq, it's possible that we continue higher, but this does look pretty tired, I would say. I know that, like, after we broke out of this range, we started to retest the breakout area, which is also important. So I don't know if we'll actually get back to retesting this range. As you guys can see, like, once it broke out of here, just like retested it a whole bunch of times. So yeah, I don't know if it's gonna do that, but if the entire Nasdaq basically has the drop that I'm anticipating personally, then I think it would very easily test this low. But yeah, I would say like neutral to bearish on FANG right now. And in the short term, maybe that's like bullish, but still, yeah, I don't really like these stocks in the midterm, to be honest. So I'm not really buying them. So Facebook actually looks more similar to Netflix, but it hasn't had the same breakout that Netflix and Amazon have. It has had that consolidation period for about maybe a year and a half or 2 years, between 2018 to 2020. But yeah, like I said, it's been lagging a little bit. And if it hasn't broken out yet, I don't think it's going to break out until the Nasdaq drops, basically. So maybe it just has to drop before it can pick up some more demand. I think like anything above between like 2020 or 220 and 200 would be a solid buying opportunity for Facebook. I would certainly step in at that point. So congrats to those that have added here in late June. And just one more time, I want to get my thoughts in order and what I think is going to happen in the market. I think the S&P 500 is going to break out of the range that it's in right now, so I'm expecting a bullish break. I think tech will continue to lag. That's one thing I talked about in my last two videos that has come true actually, is that tech has been lagging relative to XLF, which is financials, and the rest of the S&P 500, especially small caps. And even the Dow Jones actually has been doing a little bit better than the Qs for the past couple weeks. I think that will continue. That doesn't mean that tech is a bad place to be in the short term, but in the midterm, and I'm talking like anywhere from this week or maybe in the next 2 weeks, anywhere from like next week to 5 weeks from now, I am a little bit more cautious. And look, I know obviously my goal is 200,000 in 2020. So like the question is like, you know, do I try to get desperate and try to get there? Like, no, the answer is obviously no. Because I think I'm going to exceed $200,000 this year, especially if I time this right. So let's say on the Nasdaq we pull back to the previous high. I don't think we'll stop there honestly if we start pulling back. Actually, let's go ahead and look at a shorter term time frame, because that way we can look at these famous moving averages. So as you guys can see, the last time we broke these moving averages while being extremely extended, and that's the key, is that it only works if the market is super extended. But so yeah, once we eventually did break below these moving averages, obviously we had a really terrible reaction. So I don't think it'll be that bad this time around. And I mean, what would a fib target even look like? Yeah, I don't know. Maybe something between the 0.382 and zero point 0.5 would be my expectation. Actually, anything in this range. So giving up like 40% of this rally would not surprise me. To be honest, I'm sure I'm getting ahead of myself. In the past, I have not been that successful with calling tops, and I'll be the first to admit it. Like I said last year, I was just bearish a little bit too early, and I wasn't shorting when the market actually fell. So right now I just have like, you know, some insurance policies is what I call them. So if the market drops like the way I think it's going to drop, then they should really print. But yeah, let me know what you guys think. That's basically the message. Is I am midterm bearish, long-term bullish, and short-term slightly bullish. So let me know what you guys think. I'm very curious to hear your thoughts, and I'll see you guys in the next video.